Chris Konstantinos is joining us now. He's RiverFront Investment Group Chief Investment Strategist. Chris, it's good to talk to you here as we are looking at valuations as we closed, as I mentioned, Friday at records. Like any discussion of valuations, everybody's talking about that they're relatively high. Of course, you get what you pay for, I guess. So valuations are only high if people are not willing to continue to be paying those prices. And for now, they seem to be. How are you thinking through valuations right now?
Yeah, thanks for the question, Julie. I'm glad you brought this up because this has been a big point of debate within my own shop. There's two ways to look at valuations, in my opinion. You can look at them in a vacuum. You can look at them on a time series basis relative to their own history, or you can look at them relative to the alternatives in the marketplace. To your point, if you look at valuation in a vacuum, no doubt about it, U.S. stocks are expensive relative to their own history, whether you're looking at a PE multiple or price to cash flow, price to book, et cetera. They look pricey. However, I don't think you can look at valuation in isolation or in a vacuum. You have to look at it relative to the alternative. And when you pit, say, dividend yields on the S&P 500 relative to the 10-year Treasury, or if you look at an earnings yield, if you take that PE and flip it upside down and compare earnings yields to bond yields, actually the market doesn't look very frothy at all. It looks significantly more reasonably valued than you did in the late 90s or even in that mid 2000 sort of, pre-bubble era before the great financial crisis. So I think, a more holistic way of looking at valuation is the second way. And in that regard, stocks actually look relatively reasonable. Now, admittedly, they look a lot cheaper outside the United States than they do within, but that's a whole different debate.
So, Chris, we're talking about this valuation question, but I think, maybe the simplest frame here is something you say right at the top of your outlook for next year, which is this is the beginning of a new bull market for the stock market. I think a lot of people have come around to this view in the last few months, but it was a lonely place to be for a little while to argue that this was really something more sustainable. Are there parallels in your mind to the way the market behaved at the beginning of the post-crisis, rally, and are there differences, I guess, between these two market moments, at least as you kind of see things evolving in the next, let's say, 3 to 5 years?
Yeah, that's a great question too, Miles. So first of all, I do think there are some parallels. And one of the things that we're seeing right now, it's not as dramatic as what we witnessed in, say, March of 2009, but we'll see whether it plays out. One of the things we're seeing is that more cyclical business models, the business models that really depend on global growth, rebounding in order for earnings to grow, those companies, and you could put small caps in that category. In some sense, you could even put financials in that category because they're really highly dependent on the shape of the yield curve and the level of interest rates. Those companies have started to see real relative strength recently. And that is very, very reminiscent of what we saw in, Q1 and Q2 of 2009 when we were coming out of that, that deep, deep recession. In some ways, the recession that we experienced in 2020 is actually worse. If you look at it from an unemployment perspective, this is literally the biggest cratering in jobs that we've seen, since the Great Depression, frankly. But in other ways, you could argue, you look at the U.S. manufacturing PMI that came out last week, we're back to almost 60 again. We're above 55 on that, whether you're looking at the composite or the manufacturing. So, and it took a long time for PMIs to really recover coming out of 2009. So in some ways, the economic cycle was more severe in 2020, but in other ways, probably more transitory than what we saw in 2008, 2009. But from a market perspective, I think the playbook is pretty similar. Another way to look at it, and this boggles the mind to think about it, but in March of this year, we had something like almost a 40% correction in the S&P 500 in like 40 days. If you annualize it, that is the sharpest drop in the last century in the stock market. So you basically had your year and a half or 2 years of a cyclical bear market. You had it in like a month and a half. And so therefore, once I started getting my head around that, I started realizing that, this isn't the beginning of the end of the economy or the market. It's actually the end of the beginning, that what we've seen, in Q2 and Q3 of this year is actually the beginning of a new cycle. And that cycle is going to be driven, in our opinion, not only by monetary accommodation like it was in the GFC, but also increasingly coordinated fiscal accommodation along with that, which could make this new cycle pretty powerful.
Chris, a lot of folks internally here, but also on the street, really continue to look at an S&P 500 target next year by Goldman at 4,300 as high. But let me take the other side of that. If we're looking for 5 to 7% GDP growth next year, could 4,300 on the S&P 500 be too conservative?
That's a very provocative point. I would say, our base case scenario is not quite as bullish as Goldman's, although it is, constructive. But how you get to that 4,300, or to your question, how do you get to 4,400 or 4,500? It has to come in earnings surprises. Because to our earlier point on this program, multiples really can't expand a whole lot more, right? Whether, we could split hairs and talk about whether you want to put a 23 or a 25 multiple on trailing earnings, but nonetheless, historically speaking, they have very little room to rise. So where you're going to have to get that is you're going to have to get that through earnings, surprising to the upside. Right now, the consensus is about $165 for next year. I think that consensus is going to end up being too conservative. And the way you get to like a 43 or 4,400 is you're going to have to assume that you get about $20 to $25 more earnings next year than what the market's expecting. And the way you get that is some of the ways that you've talked about on this program, before I came on. The idea that you've got a lot of pent-up consumer demand, that the savings rate's high, and maybe some of that spend comes in 2021. And we saw consumer confidence numbers come out very recently in the U.S., and they're very strong. So that some of that pent-up demand is there when things, hopefully normalize with the vaccine next year.
Chris Konstantinos, thanks so much for spending some time with us this morning. RiverFront Investment Group Chief Investment Strategist.